Good day, Professor.
Professor, you're muted.
Okay. All right, I got it now. I got it. Okay. All right. Good day, everybody. Um, Quiz number 2. There were a lot of back and forth problems. But then I pass it on to IT to help resolve the problem. Was the problem resolved?
Still not, Professor. We, till the last moment, experienced lots of issues. Some people couldn't accomplish the quiz because the site were down. Some people
Oh,
experienced
wow. Okay.
issues with the question that was written in a corrupted way. So lots of us suffered in the quiz till the deadline, and we communicated with the IT team to figure out a way and discuss with Your Excellency about making a second attempt or posting a quiz, another quiz limited to the problems we faced. We still don't know the resolution that you are going to reach with the IT team with Your Excellency.
Okay. I know we had a lot of problems. I've initially tried to post to upload the quiz. It got corrupted and all those stuff. So I pass it on to IT. Um, if that let me able to talk to the person who did the update. If I can talk to the person on WhatsApp, if he fixes it, then I will fix a second attempt on Thursday, Friday, Saturday. Second attempt on the quiz too. That's the difference. I'll fix a second attempt on quiz 2 on, so let me, Thursday, Friday, Saturday. So that means if you have not attempted do the, then you have 2 attempts to make. If you have made a first attempt, then you have a second attempt to make. And then we will go for the higher score. Out of the 2 attempts, maybe I'll make it 3 attempts, but I don't know yet. But for the 2 attempts, whatever the score, we'll go for the highest score. So if the first attempt was, say, you made 70%, second attempt 90%, so we go with the second attempt. So let's look at that we can fix the problem so that we can post the quiz again as it's supposed to be, so that you do the second and third attempt. I will recommend, I think I will make it 3 attempts, so that if you have done the first attempt, then you have just two attempts to go over. And then based on the 3 attempts, we go for the highest score.
Thank you, Professor.
Okay. Is there any other questions about concern? I know you posted, I think you were the one who posted the number of questions that has no financial data. So we should be able to fix those 7 questions so that you do the second, you do the second, and you do the third attempt. So the highest attempt will be what we are going to go for. So the highest attempt, that is the highest score. The highest
national organization.
Hello, Professor.
Yeah, go ahead.
I would like to let me ask some questions. Until now, I haven't finished any assignments, frankly. But I'm trying my best to study all the units. I'm preparing for the DEX, for the final DEX, because I'm a little late to submit your all assignments. And until I think last, maybe yesterday, I also missed the midday. Actually, I study, but I missed the date. That's why, especially, I missed the dates. So I would like to know what kind of effect I may have if I pass the exam.
What kind of what?
What kind of effects, affection for my final exam if I take the tests? Because I now totally I miss all the assignments and also now quiz also, sir.
And then you should update yourself. I will, because me too, I'm going to, starting today, I want to update the grade book. I've been studying the system myself, so I want to update the grade book so that all the assignment will be the grading will be up to date. So you have not done assignment. The assignment is the basis of grades. So that is the basis which I will say, okay, this is A, this is B, this is C. So you have to do all the assignment and caught up with the assignment, because it's a standard, this is a standard program. We are running accounting and finance MBA program. So I cannot say, oh, okay, I'm basing everything on the final exam. No, I base everything on the assignment, quiz 1, quiz 2, and the final exams. So that now come to mind. So what we have left, I want us to focus on for the remainder of the weeks will be today we'll be moving over to balance sheets. Liability. We have been working on, if you recall, balance sheet, you have the asset, you have the liabilities. So we have been focusing on the asset side. So starting today, we'll be focusing on the liability side. So chapter 9 will be on liabilities, general liability of the balance sheet. So from there, we start breaking them down. So breaking them down, the next chapter will be chapter 11. We'll be reporting stockholders' equity. Chapter 11 will be reporting stockholders' equity. So we'll be working on that on chapter 11. We will not do chapter 10. Then chapter 12 will be statement of cash flows. We'll be working on statement of cash flow. And then the final chapter, which is what what we have been doing is all about, will be analysis of financial statement. So from there will be, I'll give you a final assignment, Excel, to do comprehensive financial statement analysis of a given company. So that's what we are going to do in a nutshell, what we have now outstanding. Chapter 9 will be liabilities, general, entire right of balance sheet. Since we have been handling the left side, which is the asset, we are moving over to the right side now. So based on the right side of the balance sheet, we are going to work on reporting shareholders' equity. Then statement of cash flows, we'll work on statement of cash flow, and then comprehensive financial statement analysis will be our final stop. So with that, we should be able to now focus more on the last project after the quiz 2 this coming week, or this week, Thursday, Friday, Saturday. So we'll be focusing on these 4 chapters. Our final exam will be based on the 4 chapters as well, chapter 9, 11, 12, and 13. So that be the case. So we will move on to, if there's any question you can ask now. Otherwise, we'll move to chapter 9, which is the liability side. Then we look at the balance sheet. We have done balance sheet generally, so I believe every one of you know what is on the right side of the balance sheet, the liability, current liability, long-term liabilities, stockholders' equity.
Professor, I have a question.
Any questions?
Please.
Okay.
For the last assignment, Excel, it will be about chapter 9 for next week.
The last assignment?
Yes, will be on chapter 9 or later chapters.
Okay, I have an idea because I've been running this course in other universities. We will do the last assignment will be based on more or less on chapter 13, which is everything about this course. I want you to be able to, I give you company A and say, okay, do a comprehensive financial statement analysis of this company. I say you write a report. Then at the end of the analysis, you write a financial comprehensive report about the company. And in that case, you start from, we always start from the economy as a general focus.
Professor.
Where the company, let me finish, where the company operates. If the company is in the United States, first of all, start with the general economy of the whole world. And then from there, you move to the US and then to industry, where the company operates. And then finally, you narrow it down to the company itself. Yes, ask the question.
Professor, can we have like not examples, like training for the final exam, like we, in school they used to give like similar to the exam, something similar as a training for the final one.
Okay, if we have time, that's why I'm trying to cut down the chapters. I've narrowed the chapter to 4 chapters for the final exam, chapter 9, 11, 13, and 12 and 13. So we will narrow it down there so that I'll see if we can finish on time. As soon as we finish on time, yes, we can do what we call the mock exams, where I will also interact with you as you are reviewing those questions. that will be the mock exam, so that you'll be able to know what will come for the final exam. Is that the question?
Yes,
Did I answer
thank
the
you,
question?
Professor.
Okay. All right. Okay. So today we'll be looking at the balance sheet side liabilities. So now we have finished everything. The asset side, we started with current assets. We moved to long-term assets. We have done depreciation, how to analyze and quantify inventory, opening and closing inventory, cost of goods sold. We have done all that under the balance sheet, the asset side. So today we'll be moving over to the liability side. So that chapter 9 is more or less general. It does everything about the liability side of the balance sheet. So that is what we'll be looking at now. And then in chapter 11, we'll dig into stockholders' equity, and then statement of cash flow. We left it towards the end because it's very, very important. That is why I'm leaving it to the end. Let me see if I can share my screen. So most of this thing we have here, probably you'll come across it when we're working on the balance sheet as a whole. We did balance sheet. So balance sheet, assets, liability. So most of these things you are familiar with. You are familiar with the terms because we have already done them generally. So now maybe we'll dig deep a little bit into specifics. So where you have questions, because I'm going to be moving a bit fast. If you have questions, please feel free. Pause me and ask a question. Okay, so if you look at it, reporting and interpreting liability. Liability comprises of, in the balance sheet, comprises of long-term, short-term, or more specific, we call them current liability and then long-term liabilities, then stockholders' equity. So what we'll have in that arms of balance sheet will be liabilities, long-term liabilities, and then stockholders' equity. Long-term liability, we look at long-term loan. Any liability more than 1 year is long-term. And then the current liabilities, any liability within 1 year, under 1 year. So let's look at the learning objective. Define, measure, and report current liabilities. So everybody that have a general view over liabilities when we're doing a balance sheet should have a very good idea of what current liability is. Compute and interpret account payable turnover. I remember I delved deeply into account payable. We know when account payable is created, and then we'll go a little bit further by calculating account turnover ratio, the implication of that ratio, and how do we know the number of days that items have been outstanding with the company. How many days does it take the company to pay their creditors, their short-term creditors? So that is what that payable turnover ratio will tell us. Then object 23, report notes payable and explain the time value of money. Time value of money is very, very important financial principle. It's one of the key and core principles in finance. So we will also be exposed a little bit to that. And in that case, I have here what I used to. I have been using this financial calculator for so many years now. This is BA2 Plus Professional. The best way to calculate the time value of money problem is with financial calculator. That is why I use mine. I don't want to memorize anything, so I key in the information and get the results. So you will be able to see other ways you can calculate it. You can also mentally calculate it. You can also, based on your idea of algebra, you'll be able to calculate the time value of money, where you will be looking at future value, present value, the time period, and the interest rate. Okay, so that would be 3.3, and then 3.4, report contingent liabilities. We don't need much to be done there, because contingent is that we are not 100% sure of what the liability will be. So we make a provision, and that's why we call it contingent. It's based on a given condition. For example, if a company has a legal issue with an individual or another company, they are not sure whether they will win the case or not. And if the case involves $2 million, if they lost the case, then they have to pay $2 million. Now, in that case, the company, for now, since we don't know, the case have not been decided, then they will classify such liability as contingent. So that would be 9.4. Then we will look at, explain the importance of working capital and its impact on cash flow. And if you recall, when we were working on asset side or balance sheets, we talk about current ratio, talk about working capital, and we know that working capital has to do with current assets and current liabilities. So that is why we are now looking at the other side of that working capital, current liabilities. Because if you subtract current liability from current assets, what we arrive at will be working capital. So that is why we are going to look at that. Then explain the importance of working capital is 9.5 and its impact. Okay, that's what we just said. And then we will be looking at report long-term liabilities. Now, at 9.5, we have finished everything about current liabilities. So from 9.6, we'll be looking at long-term liabilities. Long-term, anything more than 1 year. Any obligation, loan obligation more than 1 year. And then compute and explain present value. How do we compute present value, PV? I've mentioned that time value of money is very, very important principle in finance. Very important principle. We'll be able to use time value of money to calculate present value, future value, the time periods, and the interest rate. It's just changing the numbers. If we use financial calculators, it's very, very easy. Just compute, put in the information, and then press compute. The result is out. Okay, so then we'll be looking at long-term liabilities from 9.6, 7, compute and explain present value. Then we apply present value concept to reporting of long-term liabilities. So that is 9 point, about 6 learning objectives. So we'll start with the first. First, we should start by looking at what we understand by capital structure. Capital structure, if the definition is not here, is a different mix of how company raise capital. So if a company has the long debt, they have stockholders' equity, debt obligation and payment. So that put together is the capital structure of the company. So we're defining, measure, and report current liabilities. Okay, current liability, we know what it is. Less than 1 year. Maturing less than 1 year. Within 1 year, the obligation will be up to be repaid. So that would be the long-term liability, while short-term liability. Long-term is more than 1 year. Any obligation that is more than 1 year is classified as long-term liability. Let's look at this is the liability section of Starbucks. I told you everything. Now we are looking at the liability side. This is a liability section of Starbucks, and if you look at it, you can see that you have here current liabilities. All the items listed under it is current liability up to the total. After listing everything, then we arrive at the total of current liabilities. Current liability, which is total current liability here. You can see what it is, 7.3 million. And then the current portion of long-term debt, I look at this specifically, long-term current portion. Maybe one of you will ask a question, or some of you will say, okay, but this is long-term debt. Why is it not under current? Why is it not under long-term liabilities? And you know, current long-term debt, it may span over 10 years. For example, if a company is to borrow 10 million, and each year they are to pay 1 million. So for this year, the current year, the portion of long-term debt that is current will be just 1 million. So that is how we now move that 1 million from long-term debt sections and put it under current liability, because that is an obligation that is due within that year. Okay, current liability. So we can see too that many current liability have a relationship with operating activities. They have direct. For example, if we look at asset side again, when we're looking at the account receivable, how do we create account receivable? Yeah, when the company sells products to their customer on credit. But here, when company purchase items on credit, it will be under account payable. Account payable. For example, for Starbucks, you know they are famous in coffee. I know a lot of you patronize Starbucks. So purchase coffee inventory. When they purchase coffee, you can see on the purchase on credit, so it definitely will go to account payable. Rent space for stores, current portion of the operating lease is also liability. At times they rent a store for 5 years. So that current portion for 1 year that they will pay goes to current liabilities. Then employee earned wages. These are all current liability. Employee earns wages. Somebody will say, oh, why? Why are they putting it on that current liability? Why don't they pay? As at the time they are preparing the account, probably the salaries were not due, but it will be due at the end of the year or the end of the month. So as at today, they are preparing, today is the 24th. They are preparing their balance sheet. That so as at 24th, even though as at 30th, the 31st, they have to make salary payment, but they did not pay the salary between 24 and 31. So under balance sheet, it will be under accrued payroll. That is accrued salary not paid yet, because it's not yet time to pay it. So they accrue it because definitely at the end of the month, they have to pay it. Then customer pay in advance for future purchases. That one has to do with income. That is what we call deferred revenue. You can't earn such revenue because it's not yet due. Customer make an advance payment. It's okay. That product is coming up in 2 months, but I would like to pay now. So as a company, you cannot realize that revenue because it's not yet due. So that would be under accrued revenue. That would be under accrued revenue. So also you can see now too that names will be tied to whatever is being done as far as that account is concerned, like account payable, that is straight account payable. That's another name. Some companies just call it the way account payable, some companies call it trade accounts payable. That is an obligation to pay for goods that they have collected, or inventory they have collected but not yet due for payment. And by the way, that is the easiest, the cheapest way the company raise capital too. Instead of going to borrow money and then they say, oh, you pay to buy inventory, they will say, well, you are coming to borrow money, you are going to pay us 15% interest. So some company in most cases jump into going into all this type of credit relationship with their suppliers. Supplier of beans, raw coffee, or beans for the coffee. Yes, they can go to the company. The company may say, oh, I want you to buy my own beans. Instead of going to the other person to buy, I'll give you 30 days. Take the coffee, the beans, anytime, please, anytime you can. After 1 month, you can always come and pay me back. And if the other company, a company B, says, okay, take my beans and pay me cash, pay me today, you will see that as a financial manager of the company, you will go with the company that give you this credit. You say, okay, I'll go with that company because they're giving me 30 days credit. Why should I pay now? Let me channel that capital or money to something else. So then you have also accrued liability, like accrued obligation related to expenses that have been incurred but have not been paid at the end of the account. So if you accrue expenses and it has not been paid, maybe until the end of the accounting period, that is an accrued expenses. Revenue, we talk about it, that is unearned revenue. The company cannot, because a customer has come in and paid cash in advance for their product and revenue. They cannot realize that revenue until the ownership of the revenue of the product is passed to the consumer before you now say, yes, I realize this revenue. Then notes payable. Notes payable, you will not see it in any other name. That is an obligation supported by formal agreement. The company may issue notes to other companies to give them money. A note may be 100,000 notes. So that is an obligation. There will be conditionality for the notes to be for the funds to be given. Okay, we move on. Okay, accrued taxes, very, very important again. It may not be in all the countries in the world, but in US, yes, companies take this very, very seriously. In fact, some company accrued taxes on monthly basis. Monthly basis, they accrued. Okay, this is because tax is a portion of your revenue that you are going to give to the federal government. So, and if it is not paid, the government can come in and take over your business and seize your assets. So companies take that very seriously. That is why some companies do it on monthly basis. Does not imply that every month they have to pay tax to the government. No, they just accrue. Okay, we made a profit of $10 today. What is the tax? Our tax is supposed to be 35%. So that is $3.50 tax. So they will now say, okay, let's accrue that so that we don't need to bother again to make any further provision. They accrue that, and then they keep accruing until at the end of the financial year, 12 months, they will now pay the tax to the government. So that will appear as accrued tax payable. Then we also have accrued compensation and related costs. That one too. And most companies, they are very prudent in doing that. They are accrued for future payment, like retirement programs, vacation time pay. They can accrue that, the health insurance, they accrue all that. So that at the time it is due for payment, they will not be looking for money. They will not say, oh, where do we get money to pay this retirement benefit? Because they have accrued that, as at that point, they will be able to now make that payment. Okay, also we have salary taxes. That is payroll taxes. We call it, in US, we call it payroll taxes. There are a lot of it. Some of them, we call them employee portion. That is employee portion is different from the employer's portion of Social Security and Medicare. So all that also will appear under payroll taxes. That is, payroll are subject to variety of taxes, including federal, state, and local income taxes, Social Security taxes, federal and state unemployment taxes. Employee pays some of these taxes while employers pay others. So it is always separated in the form of, when you look at the employee payroll, what we call the pay stub or pay slip, you will see the employee portion. Employee pay this, pay that, pay that, pay that. That will be deducted from the gross income of the employee. But that of the company will come from the income revenue statement. All right, so we move to learning objective 2, compute and interpret account payable turnover. We recall we talked about account payable. So we will now look at account payable turnover. Most of items we touched, you have some ratios that we will need in our chapter 13, analysis of financial statement. When you are doing your comprehensive financial statement, you should note that we have been running through a number of ratios. We spread them that way so that you will not be. I know some professors put the ratios in one chapter, or the system put it in one chapter, then you end up memorizing it. But here, the way it is presented makes sense. You will know what is the composition of that ratio, and the implication of it, we discuss it. So we talk about deferred revenue. So let's go into computing that. This is using mobile data. I know a lot of you that drink Starbucks coffee. You don't go to your computer to make order. It's already, you have the apps. Me too, I have the apps too. So from there, the company, in most cases, will be able to analyze where you are. For example, I'm in the state of Florida. If I use their app, they'll be able to analyze where I am. Okay, this guy is in the state of Florida. How did they order the coffee? What is this characteristic? What is this state? What did they need? Did they need a espresso? Did they need strong coffee, or do you need coffee with cream? So they analyze all that thing just to increase their sales. So that is what it should be there. Okay, let's look at account turnover, account payable turnover. It's very, very clear. If you look at it, it's there. Account payable turnover is always cost of goods sold. We have already come across cost of goods sold. Except somebody wanted to ask me questions and say, oh, okay, I don't know what cost of goods sold. Then this is an opportunity to ask. Otherwise, we did it in the last three sections. So account turnover ratio, if you divide cost of goods sold by average account payable, that will give us what we call cost account payable turnover. And the turnover, the higher the turnover, it suggests that the suppliers are being paid on time or as at when due, as early. But when the ratio is very, very low, that means it's very likely the company is not meeting their account payable obligation as at when due. Maybe they are owing suppliers and so forth, which is dangerous. If a company start owing the suppliers of their major inventory, like Starbucks, the beans, then they are spelling trouble for themselves. So the higher that ratio, the better for the company. That means the company is paying supplier as at when the obligation is due or timely. So let's delve into Starbucks here. If you look at Starbucks 2018, the account payable ratio is 8.09. And in 2019 is 7.20. And 2020, 7.04. So I can, even without looking at it, the higher ratio here in 2000 indicate that they are paying their suppliers in a timely manner as at when due. But you can see that 2018, there was no global epidemic. So I expect the cash flow to be good. I expect that ratio to be very high. You can see in 2019, when we delved into global epidemic, you can see that that ratio went down to 7.20. So that can be explained. How many people then go to Starbucks to buy coffee? I think you may say probably no, nobody. During the global epidemic, nobody want to buy coffee. Nobody want to go there because of COVID. So you can see that they didn't pay their supplier on time. And then 2020, that ratio still further went down. So I believe if we look at 2021, which I will want every one of you to grab Starbucks, grab the Starbucks, open the Starbucks and look at that ratio, what it is. There from 10K may give you that ratio. From 10K, you go and look at for 2021. I believe that ratio must have increased. That ratio must have increased in 2021 when the global epidemic started reducing in negative effect. So from here, now that you know the ratio, if we know that we have 365 days in a year, so if you divide 365 days by 8.09, you will know the average, by average, the number of days inventory the Starbucks has paid their suppliers. You know the number of days Starbucks has paid their suppliers. So can every one of you look at 2018, the number of days it takes for Starbucks to pay their suppliers? 2018, the account payable turnover is 8.09.
45 days.
How many days?
45 days.
45 days. That is, you divide that by 365.
Yes.
Right? Okay.
Yes, Professor. 365 divide on 8.09.
Oh, very good. Okay, if that is the case, that's fine. Okay, so let's take a 10-minute break, and when we come back, we continue with learning objective 3. Um, we'll, we'll we'll continue with learning objective 3. So let's take a 10 minutes break and come back. I'm way back. I am way right back. All right, let's look at 2018. 2018, the account payable turnover was 8.09. And somebody mentioned, how many days was that? How many days on the average? The person who calculated the number of days it takes Starbucks to pay suppliers in 2018, what was the figure?
It's 45.1 days.
45.1
days.
45.1, okay. Days, right. Okay, I know the system calculated that of 2019. 2019, that was the turnover ratio was 7.20, which is 51.85 days. Can somebody else calculate for 220? Oh, 220 is calculated. No, 219 was not calculated. So can somebody calculate 2019? 2020 has been calculated already for us. So that one is
50.69.
Huh?
50.69, approximately 50.7 days.
50.69 days. Okay. So then on 2020 was 51.85 days. Okay. So you can see in 2018, before the global epidemic, it takes them just between 45, about 45 days to pay their creditors, about 45 days. And then when you look at when you look at 2019, that days, number of days increased to 51 days. 51 days. So now in 2020, it increased to 52 days. So we, if you are the financial analyst, you will just have at the back of your mind that, okay, there was no problem in 2008, but there seems to be problem in 2019 and 20. From there, you know what was the problem, because the number of days increased from 45, that is by 6 days, 51 days, and then even 52 days in 2020. And I was saying that if we look at their financial for 2021, that number of days will start decreasing, will start reducing, it will reduce. And probably this year they will post a very good, very good account payable turnover. They will be paying their creditors much often now that global epidemic is subsiding. Okay, notes payable, we should know what note payable is. Note payable is a formal written contract that specifies the amount, repayment date, interest rate. So those three items, and then the lender and the borrower. So that is what, basically, that is what notes payable is. It's a form of a loan or debt instrument. Debt instrument or loan instrument that specify the amount, maybe 2 million is to be borrowed. Repayment date, probably they want to repay in 3 years. So it's a long-term debt obligation. Then the interest rate may be 12%. So the lender also is noted. The lender may be one of the banks or individual or any finance company. And the borrower is the company. So the interest definitely as interest is accrued on all loans, because it may be accrued every day. It may be accrued depending on how they want the payment to be made. And if the payment is to be made at the end of the year, so they accrued interest at the end of up to the end of the year and make that portion of the payment. And then the other portion will be left until they move into that portion again, and then they accrue that interest and make the appropriate payment at that point. Okay, for the illustration of the cash flow or the implication of our entry, so if it is a debt, cash is being paid, so probably they'll credit the company's bank account. So in that case, that may increase the cash by 100,000. So the cash will be debited 100,000, and the contra will be notes payable, which is a liability credit 100,000. So in terms of our assets and liability and stockholders equations, you can see cash is being paid under assets, which is equals to the liability side. What is affected is note payable 100,000. You can see stockholders is not affected. Similar illustration for note payable. I will leave those illustrations for you so that we move to whatever we want to look at again. Let's look at, instead of note payable illustration, which you can do, we look at the current portion of long-term debt. Very, very important. If you remember when I was introducing, I talked about this long-term debt. Very, very important. If as at today we want to calculate long-term debt obligation, we have to include that current portion. So you can see the current portion of long-term debt is 1,249,900, while the long-term debt that is not due that is due after 1 year is 14,659.69. So my question to you is, what is long-term debt as at that point for Starbucks? Who can answer that question? What will be the long-term debt for Starbucks? Will it be 14 million or 1.2 million or what? Who can answer that question? Who can answer that question? What is the long-term debt for Starbucks if we are looking at their liabilities? Their liability for as of September 27, 2020. What is the long-term debt of Starbucks?
I get the 14.6 million.
Anybody with something different? Okay, if we are talking about long-term debt for Starbucks as of September 27, 2020, is not 14.65 million. It is 1,249.9 plus 14,659.6. Maybe a tricky question if somebody asks what is long-term debt as of September. The long-term debt for Starbucks as of September because there is a portion there. Because also it's possible that portion is due this year, but then it's possible Starbucks may come back and say, oh, well, we don't have this money to pay this year. They can go back and negotiate for another 2-3 years term. In that case, that numbers fall back immediately to long-term debt. Okay. Okay, so a little bit we look at, I talk about, when I introduce, I talk about contingent liability. What do we say about contingent liability? Who can refresh our memory? Who can refresh our memory? Long-term contingent liabilities. I need somebody to refresh our memory on the contingent liabilities. I mentioned it. I introduce it. What did I say it is?
It is giving an allowance for what may come up.
Yeah, that is well, you try. It's an obligation that is not for certain. Obligation that is not for certain. We don't know at the time. We don't know the amount involved. The amount involved not known. The time involved not known. Probably we may estimate GAAP and International Financial Reporting Standard. They always estimate a percentage of that. They may say, okay, maybe it will be 70%. It's likely that will happen, and so forth. So contingent liability is not a direct liability that we know. Okay, this is 5 million. We may not know that amount for certain. So that is what we call contingent liabilities. Some recorded liability are based on estimates. So in that case, we'll be thinking, not only estimate, we can look at the condition in which that liability will become due. Like when I introduced, I mentioned like a company being sued, taking to court. You take the company to court, you are owing us 20,000. The person who take the company to court is not 100% too sure that he will win the case to get the 20,000, and the company too is not sure that they will lose the case or they will win the case. In that case, they will not pay a thing. So that is generally what we call contingent liabilities. So this is where the two reporting standards, they classify it a little bit different. GAAPs define probably are likely to occur, say 70%. International reporting standard define probable as more likely than not to occur, and that will be 50%. So some contingent liability, international reporting standard will require reporting of a liability on the balance sheet, whereas GAAP will simply report it on the footnote because it's not due. They don't know what it is. Even though it's not due, they don't know what it is, GAAP will not report it on the balance sheet. Rather, it will put it on the note. But the international reporting standard will want to put it as either something greater than 50% or so. So if there is a case of 2 million, they may decide to say, okay, 1 million should be reported in the balance sheet as a liability. But for GAAP say no, we will not report it. We will only note it that there is a case pending, but we don't know what the liability will be. Okay, we look at working capital and impact on cash flow. Working capital. We now all know what working capital is, so we'll not dwell too much time on it. We know what working capital, current asset less current liability, that's what we call working capital. And because we are talking about current liabilities in the balance sheet, that is why working capital are surface again. So working capital and cash flow. Many working capital accounts, yes, they have a direct relationship with income and producing activities. For example, account receivable. When you increase sales and make sales on credit, yeah, that would increase sales. That would increase revenue. Account payable also, you increase inventory when purchasing items on credit. So those two accounts, hence working capital has a direct relationship with the way the company operates. So now that is in a nutshell what we have under current liabilities. So now 9.6, 9.7, 9.8, we'll be looking at long-term liabilities. Long-term. Then next week we'll be looking at stockholders. We could have handled stockholders here, but that would take us too much time. So it's good to dedicate another lecture period for stockholders' equity. Otherwise, we could have reported it under this lecture. So reporting long-term liabilities. Generally, we all classify anything that is maturing 1 year or less to be current liabilities, more than 1 year to be long-term liabilities. And under long-term liability, we have two types of debt. Either it is secured or is unsecured debt. Secured debt is an obligation in which the company who is the borrower will pledge something in return. It will pledge an asset. He may say, okay, this my factory is worth $5 million. I'm pledging it so that I will be able to get that loan from you. And then the person there will say, okay, I can see your factory is worth 5 million. We're going to loan you 4 million. In that case, that is a secured debt. That means if the company defaults in the payment, that financial company or bank will enter the company's factory, seize the factory, sells the factory, and make due the debt. And then the other arm, we have what we call unsecured debt. In that case, that is the opposite of secured. It's not secured. It's not tied to any assets. So it's an open obligation. Long-term note payable and bonds. So you can see here, company can raise capital from a number of financial organizations and in private placement. Banks is one of the major sources where company can go and raise capital. That is, they ask for loan, give me loan. The banks, that is the job of the bank. That is what they do. They can give loan to the customer, to the company. Also, insurance companies, they have a lot of money tied to their premium. And premium is not to be utilized for anything other than they can invest that premium and make some money out of the premium. The premium that is paid by the insured, those who are insured, who have insurance from the insurance company or who insure their risk. And then pension plan. A lot of big companies have very huge pension plan. You can also be open to borrowing that money to the companies. So sources of borrowing is bank, insurance, pension plan. And don't forget too, one of the cheapest sources will be borrowing directly from the stock market by selling shares to the stock market, even though that has different obligations as well. So that is not part of, not included here, but then when we are doing stockholders equity, we'll see how company is able to raise capital and money or capital in the stock market. Okay, also, there are so many companies that have international exposure. That is, they have international subsidiaries that operate outside a country, like outside US. You have a lot of companies, global companies that operate in other countries. So corporation with foreign operation may elect to finance those operations with foreign debt. It may be ideal for them. Why do you need to remit the revenue back to the parent company? And then when you want to take loan, you take loan and then change it to foreign currency. So some such global companies, in most cases, they lend money. They want to borrow money. They borrow directly from those countries. For example, Apple have a subsidiary in China. Yeah, they will borrow China yen to finance the operation in that country to avoid what we call foreign exchange risk. Amazon, the same thing. There are many companies that are doing that, which is the right thing to do anyway, because they will be able to forestall possible foreign exchange risk. So now let's look at the lease liabilities. Lease liability. Lease, you know that, for example, the car you drive, some of you probably you took a loan, some of you probably you took a lease. And when you are leasing your car, that means you are not owning that car. The car is owned by the person we call the lessor, while you, who is driving the car, even though you don't have you are the lessee. A lot of companies do a lot of things. Sometimes they will tell you it's lease, whereas it is loan, or loan is lease, depending on what benefit them. But lease, generally, you don't own the property. The property is owned by the lessor, and the lessee will be you, who is borrowing, or the company that is borrowing or using the assets. So, for example, if company A is going to a car dealership, okay, we need a new car for our manager, but we are not going to take a loan to buy it, so we need to lease. So in that case, the car does not belong to the company, but the car belongs to the lessor, but they can use the car and make what we call periodic lease payments. Periodic lease payment. So every month, if it is every month, I know some of you are familiar with it. Every month you go make payments. Next month you make payment, agreed payment based on agreed payment terms. Make payment if it is a 12 months lease, if it is a 3-year lease, so at the end of the 3 years, that is when they consider the ownership of the lease. At the end of the lease agreement, if the lease agreement is for 4 years, at the end of 4 years, then they will now consider the ownership. They will tell you, okay, pay off the residual amount. The residual amount of this car you have been using for 4 years is 20,000. If you pay off that amount, you take over the ownership of the car. That is the way the lease operates. And that is the same thing the company operates. Let me see. These are all these which you can go through. Let's move there from this to very, very important topic. I want us to look at this topic before then we can round up. That is to compute and explain what we call present value. Present value. If you remember, I talk about financial calculator like my own. I've been using it for maybe it's getting to 25 years now. The same financial calculator I have, I've been using it. So most of these obligations, like you want to make interest payment, we can use the present value, or you want to do an investment, you use what we call present value. Present value techniques. Present value concept. The value of money can grow over time. This is one of the principles of finance. The money you have today in your pocket or wallet, what more in the future? That is the principle. So based on that, you look at the present value concept. And from there, we deduce present value, future value, period. So if we have most of these components, you should be able to compute present value. So let's look at it in details here. For example, future value of a single amount. If you deposit $100 today in savings account that earns 10% interest, how much would you have after 1 year? Who can tell us what you do in where you are? How do you do this? If I have $10 to $100 to invest in your country, if I deposit $100 today in savings account, will I earn interest or not? Who can answer the question? Based on your own country. Who can answer the question? If I have money to invest, I want to save money. What will I get after 1 year? If I'm investing it in your country, I have $100. I know somebody is from Kuwait. If I save $100 in Kuwait bank, how much will I get after 1 year?
It depends on the interest rate, Professor.
So will you pay?
I don't know the interest rate right now, but we don't have taxes on individual taxes, so you will get money.
So you mean if I walk into your bank now, I tell them, I say, look, what is your local currency called?
Dinar.
Dinar, okay.
Yes.
Okay, so if I have 2,000 dinar, and then I go to your one of the banks there, I say, look, I have this money, I want to save it for 1 year. So what will you pay me after 1 year?
More than the 2,000, of course.
So how do you determine how much you are going to pay?
Because of the interest rate.
So you talk about interest rates. I was thinking, being if you are in a Muslim country, you don't. There's nothing like interest rate.
Well, no. 1 minute. It depends on the kind of the bank. There is Islamic banks and there is normal banks. Normal banks, they give you a certain rate, a certain like 1% or I'm not sure exactly how much is the percentage, Islamic banks, they don't give you they don't give sorry, what do you call it? Interest.
Interest, okay.
But it depends also. To be honest, I'm not sure if I deposit money as like saving accounts. I am not sure if I will get something.
So for Islamic bank, if I go there, say 2,000 dinars, I want to save it. At the end of 12 months, they will not pay me any interest.
Sorry, again?
I mean, if I have 2,000 dinars and
okay.
in your country, I will have 2,000 dinars, and then I go to Islamic bank, one of your Islamic banks. I say, okay, take this my money, put it in savings. After 12 months, I need the principal and something on top of the principal. Will they pay me anything on top of the principal?
I don't know, but if normal banks, yes, they will give you as per the interest.
Okay, so that means in your country you have normal bank and Islamic bank.
Yes, correct.
Oh wow, that is good. That is good. So that means if I want to save money, I should go to the normal bank. If I want to save money, because I need to make money out of it, being a finance person, so I should go to the normal bank.
Well, theoretically, yes, because even if you want to take a loan, if you take it from Islamic banks, you will take it without interest.
Oh,
like you will take a 5,000 and pay it over, for example, 5 years. Okay, 5,000 is and you are returning 5,000. But if you are taking a loan from normal bank, you are taking 5,000, but you will return it 5,500, something like that.
So that means if I take money from an Islamic bank, 5,000,
then there is no interest. No interest on you.
So I would return exactly 5,000.
Yes.
That is then good. Then how do Islamic bank make money?
I don't know.
Okay, all right. This is my idea. This is what I know, because I don't want us to keep going through what is written in the book, because what is written in the book, is written based on the US concepts. But I want us, because we are running an MBA program, we have to be very practical. But what I think in your country or in the Middle East, because I have experience in the Middle East, is that if you want to get money from the bank, whether Islamic bank or normal bank, the banks that I have seen so far in the Middle East, what they do is they want to know what you want to use the money for. If you want to use the money to buy a car, what they do is that they buy the car and sell to you on profit. So there is no underlying interest, but they sell to you on profit. If they buy the car, maybe, let me say they buy the car 200,000 dinar, very big car, 200,000 dinar. What they do, they buy it. They are not buying it and giving it to you, right? They buy it and sell it to you. They are the buyer, and then they are the seller. So if they buy 2,000 from the dealership, they sell it to you at 2,500. So that make the difference is profit. I think that is how you can handle this aspect of the lectures we are on now. If I make anything that is not correct, can anybody correct me? And also, if you need a personal loan, what do? They go to the market, and buy, say gold, and then sell it as if they are selling it to you, and then they buy it back. In that case, they make the difference. So in most cases, they buy the product, sell the product to you, and make the profit. I think that is what is allowed under Islamic doctrine. Anybody can correct me if I'm wrong. So I'm correct. The last person that spoke to me, am I correct?
Sorry, sir. I was responding to my daughter. I'm sorry. I didn't hear the question again, please.
Okay. What I'm saying is that the way you operate in Middle East generally is that interest is not really the focus. You don't mention interest, but then if I need a car, I don't have money to buy a car, I go to the bank, whether Islamic bank or any type of bank in the Middle East, I say, okay, I need to buy a car. What they do, they are the one to buy the car for me.
Yes,
They will buy
happens,
that car. Yes. They buy the car for 2,000. I'm just giving an example anyway for the number. Say 2,000 naira, dollars, sorry. They buy the car $2,000 and then they sell the car to me. But they go to dealership and pay 2,000 to the dealership and get the car. And then they come to me and sell that car.
And sell it for 2,500. Actually, this is true.
So
it happened with me.
The 500 is the profit they will get, not interest.
Yes, it happened with me personally. When I bought my car.
See, okay, so that means I'm correct. So, but that is how I think that is how they operate. I'm looking at Islamic finance too. I'm trying to see if I can write a paper on it. So that becomes, the 500 becomes the profit. So what you are getting here from this lecture now is the way the conventional banks, and in particular in US, that is the way they do their own calculation and investment, you know. And being a student of MBA too, you can go for that. Okay, so you bought a car for 2,000, you sold it for me for 2,500. Yes, you can be able, they call this profit, the bank call this profit, but you can be able to now analyze and see what is the interest you are paying for that car. Even though it is not based on interest that doing that. So what we are having here is what we do here, how to calculate interest. You go to the bank and put $100 in savings account. Then what will you get? What you get after 1 year is what we call future value. So today, I want you to take note. Today, if we invest, we say $100, we are putting it in savings account. And then we want to go back and take this money after 12 months. 12 months, 1 year. 12 months, 1 year. So that is 12 months or 1 year. So in that case, what will be your own reward for giving the bank your money for 1 year? That will be the interest rate you are going to pay, which is 10%, for example. So in that case, if you calculate 10% of $100, which is $10, so if you want your money and the interest back, so what you will get is $110. Anybody clear with this? Everybody understand this? So that will be $110. And then, yes, so now we have that is 110 become what we call the future value. The future value. And the $100 initially you deposited is what we call the present value. The reward you are getting is the interest rate 10%. So based on this, in finance, we're able to fix a formula whereby we say future value is equals to present value. Present value.
That passes by without me waking up in the middle of the night.
Who is talking?
Yeah. So it's either.
Huh? Somebody's talking to me. If somebody's talking to me, okay, future value will be equals to present value. So you can see that you can see that $100 we invested for 1 year at 10%, we arrive at the principal $100 plus the interest. Interest, we calculate 10% of $100 per annum per year is $10. So that means principal plus interest will give us $110. And that 110 is the future value. So now in finance, instead of going through all the theoretical aspects, we now put that future value is equals to present value. You open parentheses, 1 plus the interest rate, all to power the period. The period will be n. The period will be n. So, or we use our financial calculators to calculate that. Use our financial calculators to calculate, just like what I did, you calculate the interest rate for 1 year, for 2 years, for 3 years, add it to the principal. And also, if you check your slides, your notes, you will see where you get what we call future value factors, present value factors. You can use those factors depending on number of years. If it is 1 year, you go there, you check the present value factor, you will see what the factor should be, and then multiply it and get the present value. So it's good, either you use the financial calculator or you use, you can also use Excel to calculate this. You can also use Excel. So if you look at it, if you need 100, okay, also, you can also calculate present value. So if you need $100,000 in 1 year, that is future value. How much would you need to deposit? So everything is tied to the same type of formula, which I want you, every one of you, to learn. That future value is equals to, if you call present value FV, and future value FV, that is F and V, that is future value. Present value P and V, PV. If you multiply present value PV by 1 plus the rate plus R raised to power n, that will give you what we call future value. Then you can manipulate that equation, and then be able to get present value as well. Either you manipulate, get present value, or manipulate the equation and get future value. How many of you have seen that equation before? Everybody? Everybody have seen that equation before? Everybody have seen this equation. I will write it down here. P, future value. Nobody's talking. I want you to get this formula so that you use it and do the calculations yourself instead of going through the theoretical using calculators to calculate first the interest rate, and then you keep going. Or you use the table. The table is there with you.
Can you say the equation, please, again?
Huh?
Can you say the equation again, please?
No, I'm going to write it and show it to you. Present value, future value, future, so that you use that equation instead. This is present value. Present value 1 plus, this is rate, all over n equals to number of years. I want everybody to see, can you get this? Everybody see this? If you look at if you see my face is there.
It's not clear, Professor. Can
It's
you
not clear.
repeat you repeat again?
Okay, future value is equals to present value.
Okay.
Open, then you open a bracket open.
Okay.
1 plus R, bracket close, to the power of N. N is the number of years. I'm going to write it with a red pen. I want everybody to get this so that we don't even go into most of these things that will give us much time. If we can manipulate this formula, we are good. What of this one?
Power by.
What of this one?
Yeah, this is much clearer.
Okay. This one is clear?
Power by what?
N. N is the number of years. N is number of years. So that would be future value equals to present value PV. Now if FV is future value equals to present value PV, then bracket open 1 plus R. R is the rate, the interest rate we have been talking about. Bracket close to the power of N. N is the number.
How do we calculate the power? I mean, it is very, this is like more than 15 years ago.
Huh?
No, this equations is like, and the power is like more than 15 years ago for me.
No, theory is never old. It's never old.
No, the way of calculation, I don't know how to calculate the power.
But then, have you done, before you do this course, you know what course you're supposed to have done? You're supposed to have done algebra because we're doing a lot of calculations. Look at me, I'm using financial calculator. You don't need to use this formula. You don't need to. You use financial calculator or you use Excel, but you want me to sit here with you and start saying, okay, interest rate for 50,000 is this. No, I won't do that. Is that one not as old as history? If I tell you calculate simple interest of 5.
No, I will get it. I will get it. No worries. No worries. I will get it. No worries.
Okay. All right. Okay. All right. So the present value, why we are introducing present value, because bank's liability rests on the fact that some of these interests are being calculated. They are being calculated and accrued over time. And that is where we talk about present value, or the time, or in most cases, the principle where I'm trying to explain to you. It may not be exactly accounting principle, but it's finance principle. That is what we call the time value of money. Time value of money. So that is what I mean. So if I say, like now, for example, they say you need $110 in 1 year. How much would you need to deposit in savings account today if this savings account earns you 10% interest? So you can see, what are they looking for? They're looking for what? Future value. So if that same formula I'm giving you now, if you use it, future value is what they're looking for, equals to the present. Okay, or need. Okay, let me come. If you need $110 in 1 year, how much would you need to deposit in savings today? So what they are looking for is present value. Present value. And that formula, I said that future value equals to present value into 1 plus the rate to power n, the number of years. So if the number of years is 1, so now, first of all, you have to manipulate what the present value is. So based on the formula I give you, what do you think the present value will be? For those of you who have done algebra in the college, because this is one of the prerequisites for this course. Who can tell us what the future present value will be? I don't need to go into the system of calculating what it will be, but I can use that formula right away. So if you manipulate based on algebra, college algebra, present value will be equal to future value divided by 1 plus r to the power n. But then, if you checked your notes, you will see where they refer you to the table, or you will see the table at the end of the textbook. So head or tail, you must get one of these. Either you use the formula, which is very easy, or you use the table at the end of the textbook. Is there. I can see, let me see where they say you should get the test. Get it. I will not move until, where is it? There is where they say you should get the table. I thought they mentioned it. Yeah. Okay, let me see. Let me see if I can get that. Compute the value table. Notes. If you checked the back of your, I think after chapter 13, you should be able to see some tables there on your notes. You should be able to see some table on your notes. Can somebody open and tell me what page is the table? Okay, I got it. You will see table E1. Can you write it down? If it's there on your slide, table E1, appendix E, you will see present value. Present value.
Which page? What is the page number, sir?
If you look at table E on the textbook, table E. There you will be able to pick when you are asked a question that involves present value. So you go to present value table, and then you will see under the table, you will see in different interest rate and the number of period N on the vertical. And then horizontal, you will see the different period. Have you seen it?
I have found the like it's
table.
in page number 503.
Okay, you see table E.
Table. Yes, I equals 5%, I equal 10%,
Okay.
I equal 14%. Am I right?
Good. Yes, the one we are using because they say the I should be 10%. So under I equal to 10%, you will see the vertical line there, you see N. You see N on top?
Equals 7.
Huh?
It's equals 7.
Equals 0.7513.
No.
No, okay. Look at that table. Okay. On the heading of the table, you have N, 1, 2, 3, 4, 5, and keep going. Right?
Is it in the appendix or in pages?
In appendix.
Appendix.
In the
No,
appendix.
I'm in the pages actually.
Okay,
In
I will
the
want you.
chapter.
I will want every one of you to go through. Go to the appendix where you see the present value table, and under the table you will see the first thing you see is N. N represent number of years or period. So you see N from 0, 1, 2, 3, right down. And then on the right hand side, you will see R equals to 5%, 10%, and so forth. So if you are using the table, instead of getting the formula, instead of calculating anything, the best thing to do is, if you are using the table, you go to the table, and if it is 3 years, you check N equals to 3, and then you draw a line to 10%, what value is there on that table for 10%. So in this case, the value that will be there will be 0.75131.
131.
So
Yes.
if you multiply
it,
that
yes.
by, say again.
I found it.
Very good. So let everybody take the same effort and do it. I cannot do it for you. I cannot carry the table and bring it to you. You have everything there with you. But so you either calculate using formula. The easier one, especially if you are taking an exam, probably you want to use the table. You just open the table. I'll provide partial table if we are doing any exam that involve it, which I know we are. You now go to the table, pick the number, multiply it by the future value or the value that is given, $1,000 in this case. So that means the amount you need to save to start with, the future value will be $751.31. But go and apply the same thing on the formula I gave to you. You will see how easy it is, that you can manipulate it easily. And also, I don't know how many of you have financial calculators that I have. If you have financial calculator, that is the easiest. People who take CFAs and we use financial calculator, you go straight there, you put in the number, you will see what we call the present value PV. You see the future value FV. You see the payment also, and then you see the I/Y, that is the interest rate, and then you see the N, the period. So if they are giving you, if the question give you N and give you the interest and give you the present value, it did not give you the future value. Yes, you can compute the future value by entering all the numbers and you press compute. I want you, every other thing from this slide up to the end will be about learning how to compute those numbers, learning how to use the Excel, which I will want every one of you to go through to the end. And if there is any question you have, feel free to ask me anytime. So that will be the end of our own lectures today. So now from this present value to the end of the chapter, including the supplementary that I've added there, please go through it. Make sure you know how to calculate present value. Make sure you know how to calculate future value. What if number of years is not given? So you can manipulate also based on the same table, Excel spreadsheet, which you are going to study too, and also the formula. The formula is the best way to go. Any question? Any question? If there is no question, that will be the end of our lecture. Please, you have a lot to do in this chapter because I want you to know how to calculate the present value, future value. Do it. If you have any question, please refer back to me. Otherwise, if there is no question, that will be the end of the lecture. Yes, you have any question?
No, Professor. Thank you.
Okay, all right. Thank you very much. Please try to learn the present value, future value, anything about time value of money before you do the calculations yourself. All right. Thank you.
Thank you, Professor.
All right. Goodbye.